Nice. So my talk is called Bitcoin's Migration to a Multilayer Ecosystem. And this is something that I've been thinking a lot about over the past few years. Probably since the last bubble in 2017 when the last bull market cycle, when the market started to go crazy. That was the first time we actually saw the transaction fees get expensive. But before I get to that, let me introduce myself real quick. My name is Wiz. I have a bunch of projects that I work on, a little bit of everything. But basically, I grew up working in a data center. So I run an ISP to host like various Bitcoin infrastructure. So for example, in Bitcoin Core, when you start up a full node, it connects to like 9 or 10 DNS seeds. One's run by BlueMat, as you just listened to a few minutes ago. I run one of those. MZ, a few other guys around the world. There's only 9 of them. I used to do mining, or still do a little bit of mining here and there, back in the early days, not so much now. Nowadays, I do more projects like the Mempool Space Explorer or the Bisque P2P exchange network, which I'll explain later on. I have a few other sites like bitcoinonly.com. I run that with 6102, and bitcointv.com, which is an old project that just got an upgrade where it's basically a video citadel. If you don't want to use YouTube, you can use bitcointv.com and just find a ton of curated educational content about Bitcoin. So that's one of my other projects. I have a meetup group in Tokyo. We started in 2014. Haven't had too many meetups recently, but also kind of organized the Japanese release of the Bitcoin standard. So we translated that into Japanese, and it's coming out in the next month or two. And I'm also on the board of the Liquid network, which I'll talk a little bit about soon. So just to start off, just to review the basics. So, there's a lot of people here. I want to just start at the very basics and kind of go through it. What are the problems with the current fiat money system? And this is something that everyone probably already knows to some extent, so there'll be some review here. But just to go over real quick, I think you can quantify some kind of money system with a few simple properties. So for example, when you talk about a store of value, you want it to be inflation resistant, so nobody can print out more money and steal your value that way. You want it to be seizure resistant, so nobody can just reach into your bank account and steal those funds out of there. And you want it to be censorship resistant. So if you want to send money to some place that the government doesn't want you to pay to, you should be able to decide that on your own. And when it comes to a medium of exchange, there's a different set of properties that we all care about. The most obvious is probably the transaction cost. Everybody knows credit cards like 3% or something like this. And that can get quite expensive, right? But when it comes to fiat money and credit cards and things like that, they're very convenient and they're very popular. That was one of the things that always surprised me when I come to USA is like everybody takes credit card and they almost look at you weird if you want to pay with cash or something. So fiat money is a stored of value. Obviously the Federal Reserve loves to print money and steal your value from inflating the money supply. They love to reach in your paycheck and steal your taxes right out of your paycheck before you even get your paycheck. You can't send money. Like how many times you had your card stopped by the bank because they didn't like what you were doing or something. So it's very bad for inflation, seizure, and censorship. Those are like the worst properties of the fiat money system. And then when it comes to credit cards, you have to pay like 3% if you're a credit card merchant. And so that gets added on as like an additional tax on the backside in a way. But again, they're very convenient and they're very liquid, and they want you to keep using that fiat money system forever. Store all your value in fiat money so we can steal it away from you without you realizing, and use all those credit cards every day so we can take that additional percentage tax from you. So how does Bitcoin fix this? And what exactly does Bitcoin fix in regards to these properties? First of all, this is just basic. Bitcoin enables untrusted individuals to reach like a distributed consensus through a process called mining. They're basically solving the Byzantines' general problem with the proof of work. And this was a long problem in computer science for a long time, but finally some smart cypherpunks figured it out, and they used that they use the distributed consensus mechanism to secure the blockchain. And on this distributed ledger database, we can now have bearer asset tokens that can just be moved around, and that's the first form of true digital scarcity. And then you take that digital scarcity and you make it inflation resistant, seizure resistant, censorship resistant, and you end up coming up with a near perfect money system, or at least the best one we've invented so far. So what does that really mean, though? What is a perfect money system, or what is a perfect store of value? And what does that even mean? Well, it's inflation resistant because nobody can just print out more Bitcoin, right? It's this hard money. It has a halvening every 4 years, so eventually there's just no more Bitcoin to mine, and we hit the maximum supply cap of 21 million Bitcoin. And if you study the Bitcoin Standard Book or other stock-to-flow models, this will eventually become a stock-to-flow ratio of infinity because the flow will hit zero. The new supply of Bitcoins hitting the market will get zero, and you'll just have the existing stock. And that's much better than even previous hard monies like gold, where gold still has something like 3% inflation every year just from the new gold that's getting mined out of the earth. So gold was the standard of money for thousands of years, but that was pretty much only because that was the best natural form of money that humans figured out how to use. And the problem with that, even having a stock-to-flow ratio of a few percent, is that if the price of gold goes up from $2,000 to $3,000, well, that creates this huge financial incentive for gold miners to go into the earth and mine out more gold and then dump that gold on the market, and then the price will come down. And this is something that Bitcoin fixes, because no matter how high the price of Bitcoin goes, you cannot just mine a ton more Bitcoin out of the earth. The supply control schedule will increase the difficulty as more miners join the system. So that's the first thing that Bitcoin really made a breakthrough and fixed. The next is the seizure-resistant nature. By using public key cryptography, every transaction has to be signed with whatever number of private keys it's secured by. And this means that the government can't just reach in your bank account, or the credit card companies can't just charge back the merchant transactions whenever they feel like it. This was actually probably a new word in the English language, not sure, unconfiscatability. This is like Bitcoin is the first thing that's truly unconfiscatable. And so Bitcoin invented like seizure-resistant money, and so that was the second big breakthrough. And then, of course, Bitcoin is censorship resistant. You can use it to make the payments they don't want you to make by distributing the trust of the Bitcoin network amongst miners using computational power instead of human power and authority. And so it's kind of a weird concept. A lot of people think Bitcoin is trustless, but there's actually arguably no such thing as trustlessness. For example, when you sit down in a restaurant, the restaurant trusts you that after the meal you're going to pay the check. Or if you go to a vending machine and you want to buy a drink, you put a coin in the drink, you're trusting the vending machine that it's going to dispense you the drink. And if you have some dispute in the real world, maybe you take it to call the police, or you use the court system, you're trusting the state to resolve that dispute in some way. So there's always some trust. It's just that trust gets distributed amongst more people with more checks and balances. And so in this case, the big breakthrough was using computational power, distributing it amongst computer hardware. And so the trust is distributed amongst all the miners collectively. So as long as the majority of hash power from all the miners in the whole world is following the financial incentives to just be honest and mine the most profitable transactions into the blocks, Bitcoin works great. And so far it has worked excellent since its inception. There's a few hiccups here and there was a few miners who tried to pull various things. I'm not going to get into that in this talk, but it pretty much works great, and this seems to be holding up. But it's important to remember that Bitcoin is still trusting the majority of the hash power all the time. And so this is why mining needs to be very difficult and consume a ton of electricity, and it's because this is the only thing that secures the network. So there's some common FUD that says you need to, Bitcoin uses more electricity than some countries, some number of countries, but that's that's a good thing because that means even if those countries used all of their electricity to try and attack Bitcoin, they wouldn't be able to, right? And so it just depends on who's telling the story, how they can spin it. And likewise, on the opposite side, to keep those miners honest, verifying blocks needs to be as easy as possible. So computationally simple on low-powered hardware. And so how does that actually work? New transactions made by everybody are signed from your wallet, and once they're accepted by some Bitcoin nodes, they're validated, verified to conform to all the rules, and then they enter the mempool. And once they're in the mempool, the miners take those transactions out of the mempool. They can take whatever transactions they want, but of course they're going to want to take the most expensive, the most valuable ones out, and they're going to want to include those in the blocks. And so there's validation on the transactions, then there's validation on the blocks, and the full nodes verify all of that data, everything in the entire blockchain. And so any invalid blocks or transactions would just be rejected by nodes, and if you tried to do something, you would just get forked off the network, basically. So what are those rules exactly? What are the full nodes verifying? There's a few. There's a ton of consensus rules and also policies, but it can be grouped into like the monetary policy rules, enforcing the supply schedule. If some miner mines a block that says I get 1 million Bitcoin, that would just be rejected. The transaction rules, verifying all the cryptographic signatures are legit, and nobody's double spending anything, because that's a huge part of Bitcoin. And another very important part is the block rules, which is enforcing the difficulty adjustment, and more importantly, the block size limit. And the block size limit is something that was a huge debate. There was a lot of propaganda and fighting a few years back. But basically, this is a common thing that most newcomers to Bitcoin don't understand. It's like, well, why is there a block size limit? Why don't we just make the blocks bigger? And what are you guys doing? Why would you make small blocks? That limits the amount of transactions you can do. It's so we can have a network that looks like this, right? We want to be able to have an impenetrable fortress of verification and validation. So if everybody is running a full node, we can verify everything, right? So even if you just have a tiny little Raspberry Pi, you want to be able to verify the entire blockchain and all the blocks and transactions in it, so that we can keep the network honest. And this is what we're doing, right? We have a small block size, which results in demand being greater than supply, right? Everybody wants to use Bitcoin, so there's a finite number of transactions that can fit into the block. The blocks only come about 10 minutes or so. So this creates a situation where the demand exceeds the supply. And so we have the transaction fee market. And this is a huge point of contention for a lot of people. But for example, just a few months ago, it cost over $20 to do a high priority Bitcoin transaction. And the lower priority transactions were just totally priced out of the network. And many people got upset about this, and they don't want Bitcoin to price them out. So of course they're upset. But the fee market is very important and very good. You can see it's been developing steadily, and this is important because after Bitcoin's inflation drops to zero, this huge demand of fees, this is from my site mempool.space, you can see that users are willing to pay $20 for a transaction, and even much higher values sometimes when the network gets congested, to get their transactions through. And this will compensate the miners after the block subsidy reward goes to zero and the inflation stops. So to compare it to the original fiat system, Bitcoin is a store of value. It fixes the inflation problem by making inflation resistant, fixes the seizure problem, the censorship problem. But because the transactions can become expensive, it's not the best medium of exchange for buying a coffee or even everyday transactions, $100 in size. And it's you have to transmit your transaction into the mempool. You have to wait for it to get confirmed. Maybe you didn't use a high enough fee. Maybe get stuck in the mempool, and maybe you need 3 confirmations or 6 confirmations. It's not the most convenient payment method. Is just sliding your credit card and walking out of the bar. And because of those 2 reasons, the high cost and the low convenience, it's not widely accepted. You can't just go to the Starbucks and pay with an on-chain Bitcoin transaction. Usually they're using something else. So this is not a new realization. Even back in the early days, Hal Finney knew this would be the case. Bitcoin cannot scale to have every transaction in the world broadcast to everyone, including the blockchain. There needs to be a secondary layer which is lighter weight and more efficient. And so this is why Bitcoin is migrating to a multi-layer ecosystem. But how do we, if Bitcoin is just the base layer, how do we build on top of that? Well, there's 30 years of history from the internet you can look on. When you view some blog article on a website, or you're browsing memes, cat photos, whatever, you're actually 7 layers deep in the internet protocols and layer stack. And you might use HTML in HTTP and TLS, over TCP, over IP, over Wi-Fi or Ethernet or fiber optic cables. And we've had decades for the internet to figure this out. And this is how you build a full stack of protocols. And I feel that Bitcoin will evolve in the same way. So far there's only about arguably maybe 3 layer 2 networks on top of Bitcoin. And these are all very early, very early stage. Everyone probably knows the Lightning Network, right? It allows you to run your own Lightning node. Yeah, Lightning's awesome. Users open payment channels with each other, peer-to-peer, and then you have some payments back and forth. And even if I don't have a payment channel directly with you, I might have a payment channel with somebody else, who has a channel with somebody else, has a channel with somebody else, and you can do these multi-hop payments to pay the guy you actually want to pay. And this is also how the internet is structured. We might not all be using the same ISP, but my ISP is connected to some other guy who's connected to your ISP, and that's how the routing on the internet works. And so this is what the Lightning Network looks like today. It's got thousands of nodes all over the world and tons of payment channels. There's something like 1,400 Bitcoin locked into the Lightning Network and over 20,000 nodes. So it's really happening in terms of adoption. This is probably the coolest layer 2 network that solves the Bitcoin problem. And so there's custodial Lightning wallets, of course, and the self-hosted. I'm not going to get into the risks. You should use self-hosted Lightning wallets if you can, but it's also reasonable if you have $100 on your phone to just use a custodial one so you don't have to deal with running your own node. There's trade-offs to both. But the important thing is to use Bitcoin as a store of value so you get all the inflation, seizure, and censorship-resistant properties of it, and also the low cost and convenience of using Lightning as a medium of exchange. It's getting more popular, and as it does, this will probably be the primary way to do everyday payments. So another layer 2 network is the Liquid network, and this is a bit different from Lightning in the sense that it's not individuals peering with each other. It's actually about 50 enterprise companies that formed a federation, and the security model and everything is a bit different. You peg funds into Liquid. It's secured by the federation, and then you can trade funds with any of the members. And so they're all kind of financially, they're kind of like miners in a way, but kind of not. They create blocks and they put transactions into blocks, and you can trade with them. But there's some trade-offs, right? You're dealing with these group of almost 50 companies now, pretty large exchanges on here. But if you're doing business with any of these exchanges or 2 or 3 of them, it makes sense to use Liquid to send between each other. But the way they kind of become censorship resistant is a very different model. They use jurisdictional arbitrage. So say there's 15 functionaries and 2 of them or 1 of them is in a different country. You have 15 different functionaries, 50 different countries. It's hard for governments to really put pressure on them effectively because they can all kind of throw their hands up and say, well, I don't know. The other guys are doing it, it's not me. You have some plausible deniability. And so far, there's almost 3,000 Bitcoin in the Liquid network. There's almost 60 members now, and 15 functionaries. It's slowly getting some adoption, but it's not quite to the level of Lightning yet when it comes to everyday things. And because it's governed by a federation, you're trusting the collective Liquid federation. If 11 of 15 of the functionaries wanted to do something, and they really collaborate together, they might be able to do something. So it's not good as a store of value, but it might be good as a medium of exchange. You still want to keep your Bitcoin funds in cold storage on main chain, but Liquid might be cool for some medium of exchange use cases or trading use cases. The last layer 2 network I want to talk about is Bisque, which is a project that I really love. It's a different type of layer 2 network in the sense that it's not payments, it's about trading. And so it allows Bitcoiners to trade fiat, like real cash in your bank account for Bitcoin directly without KYC. It's also a similar type of federated model, but it's not run by companies, it's run by cypherpunk guys. So like individuals like me, there's like 15 or 20 guys that run it. A lot of them are pseudonymous. We don't know who they are, but Bisque is the place to go if you want to buy Bitcoin and stack sats without the IRS knowing about it. The decentralized governance structure is like, okay, you got these 20 cypherpunk guys basically running it, and the users trade directly with each other. They set all the trades outside of Bisque, and if there's a dispute with the trade partner, the federation will resolve it for you with mediation or arbitration, different ways. So check out Bisque. It's a great way to buy Bitcoin. It's like a desktop app. You trade directly without KYC. There's already been like 100,000 trades on Bisque between Bitcoiners, no KYC. So the project's doing great. And KYC is the illicit activity, is our slogan. So the next step is what's going to be on top of these layer 2 networks. It's basically going to be the application layer, right? So whatever applications you can imagine, such as mobile apps like Lightning wallets that run on top of the Lightning network, that Lightning is running on top of the Bitcoin network. The Bitcoin network's running on top of the internet. All of these, this full stack is kind of like the future, and it's going to look a lot like the internet does in terms of the full stack of layers and protocols. So if you have a Raspberry Pi full node at home, this is a great way to use the Bitcoin full stack. There's this really cool operating system now called Umbrel that actually has a self-sovereign Bitcoin app store. You can install BTC Pay, you can install mempool. There's going to be a bunch of apps developing off of this architecture where you run your own Bitcoin node, you run your own Lightning node, and then the application layer on top is going to be something like Bisque or something like mempool, or even other more fun things like if you want to watch videos and pay the creators directly to kind of like a Patreon system, but directly with Bitcoin for their content. This is a good example of an application layer that runs on top of the layer 2 networks and the other things. So you got to pick the right tool for the job, basically. Sometimes it makes sense to pay cash. Sometimes it makes sense to do a bank transfer or pay with a credit card. But when it comes to storing your life savings and your net worth, you probably want to do it in a Bitcoin on-chain, right? And if you're doing between exchanges, maybe Liquid is a good use case, or if you're buying coffee at the cafe, maybe Lightning is the right use case. You really have to evaluate. All of these are just tools and options, and there's going to be more things. Maybe sometimes Twitter is better for discussion, or Instagram is better for photos, and everything has its own trade-offs, and you got to evaluate these on your own and do your own research. So thank you very much for coming to my talk today. I'm Wiz, and love you guys.